Right now, you can watch the news, cost of construction, cost of materials.
Through the roof.
Through the roof.
Yeah.
Well, okay, so then new houses are more expensive to buy, and which makes it harder for apartments, people living in apartments to go buy their first house.
Correct.
Yeah. Well, that's positive pressure pushing up apartment rents because they can get away with charging more for the apartment because they know, hey, your alternative is to go buy a house, and those are getting really expensive. So all these factors are pushing up prices.
Well, the other thing that pushes it up is that with rising interest rates and rising costs, companies aren't going to want to build new apartments probably right now, right? Because it's a little riskier. So that means
you'd have to be crazy to build new apartments right now.
You would, really crazy.
Hey guys, and welcome back to How to Invest in Commercial Real Estate. We are a podcast breaking down commercial real estate investing for the average person. And today we just wanted to take a look at just kind of some macro trends we're seeing in the market. Obviously, we're always buying and selling and looking at our investments across the portfolio and seeing if it's a good time, to buy or sell or hold or refinance. And there's a lot going on. There's a lot happening. And today we just wanted to dive in.
Sounds good.
So I think a big thing that you need to focus on is everything is so expensive, right? Everywhere you look, crypto is setting a new high. The stock market is on a massive run. I mean, it's hitting highs. I mean, you're going to have some little dips every now and then, but generally speaking, everything is just, so expensive.
It's been crazy what prices are doing. We've been doing this. We've been investing in real estate since 2002, 2003. And never in my investing career have we seen anything like what we're seeing out in the market today. And for those that are listening, we're in Tulsa, Oklahoma. We do buy nationally. We have properties across several different states. So it's not just a localized deal. It's everywhere. And I think it's pretty much over all the asset classes.
Yeah.
Particularly, though, multifamily is just skyrocketing right now. NMHC just finished up. I believe it was in Orlando this year. And
that's the National Multifamily Housing Convention
conference or convention.
Okay.
Yeah, that's really the big dog of multifamily housing conferences. Everybody's there. Everybody's got a new $500 million fund that they got to get placed in the next 6 months. It's crazy.
And do you think that's because in general, business has been really good and the economy's been really good for a long time. Interest rates are low, so there's lots of buyers? Or could it be because the economy's done so well for quite a few years that there's really low unemployment, so people can afford to pay a little bit more when they're renting? I mean, is it some combination, or do you know what it is? I mean, what do you think?
Okay, this is a show about our opinions, so I'm going to give my opinion. You hit on a couple of them. In my lifetime, we've never had a bull run like we've had this long. 2008 was tough to get through, but by 2010, we were starting to come out of it.
Yeah.
And then we were humming along 2015, 2016, and everyone thought, we're going to have a correction, but we never did.
Yeah.
And so now we've got 12 years of complete unemployment going down, interest rates all-time low, generationally low. For that long.
Yeah.
So the stock market near all-time high, a lot of positive stuff going. I think that's a lot of what's driving it. And then of course,
plenty
COVID,
of money for buyers, right?
Yeah. And so COVID, think about the Trump and Biden administrations, both of them pumped trillions of dollars into the U.S. market. Mm-hmm. Trillions. That's thousands of billions.
Well, even back quantitative easing, Obama did it too. So it's really, there's been over the last 10 years.
Quantitative easing.
Yeah, literally printing money and dumping it into the economy. And I'm not going to get into the politics if that was the right or wrong decision.
Right.
Obviously, it helped, and we have this amazing economy, but all those trillions of dollars are circulating in the market, changing hands, goes from one income column. Oh, I made money. Then they go spend that money, and it ends up in another income column. And the faster the economy gets heated up, the more the same dollar counts for income for multiple people, and everybody feels richer.
Yeah. And coterminously, they're lowering interest rates on the debt, and they're making it easier to get in a lot of respects.
Yeah. Debt, they've kept it near zero now for a long, long time. Now, so what's unique about today is we're gonna look at what we have as a super hot real estate market where prices are setting all-time records.
Yeah.
You got really low debt, which has been fueling a lot of that. But now we're going to see the Fed stepping in and starting to hike interest rates.
Yeah.
Because they're going to try to slow this thing down. So that's going to be interesting to see, okay, we're at what has to be the peak of a cycle or close to it. And we've got monetary pressure from the Feds that are going to bring interest rates back up. So what does that mean? Should people get out of real estate? Should they sell all the real estate? Should they be buying more? And that's what we can talk about today.
Yeah, I think I want to go back real quick to what Brian said earlier about why, multifamily may be heating up. I think from the consumer standpoint, we watch them and we watch all of these people, for the most part, pay their rent during COVID. It's a very stressful time on a lot of asset classes. You don't know what's going to happen. You don't know who's going to pay or what your income is going to look like. And a lot of apartments had pretty good collections. People paid their rent. People paid where they needed to live, and the government was giving them tons of money. So I think you got a lot of rent growth over the past couple of years that people may or may not have been underwriting.
For sure.
And industrial has been going insane as well. I mean, you see people nabbing up industrial, primary jobs like crazy. And I think that also relates a lot back to COVID, because you see that these primary manufacturing jobs that stayed open during the economy, because they were, while the economy was shut down, let's say during COVID, they were so important that they paid their rent. They were still operating, they were still manufacturing, they were still producing revenue. It seemed like a safer asset class to invest in than some others because of the priority going on.
No question, multifamily has the least perceived risk in the future. People always need a place to live. Yeah. If there's shortage of units, people are always going to make that house payment or the rent payment first.
Yeah.
What struggled a little bit was retail through COVID, because people are shut down. They're more afraid to go into businesses. People want to pick up the drive-through. They want to get it delivered to their house. So brick and mortar retail has a higher perceived risk, and so a lot of the dollars are hitting multifamily. And you mentioned industrial. I can't help but think that the main driver of that is a strong economy, but also cannabis.
Oh yeah,
because now we have literally a crop that everyone wants to grow indoors.
Yeah.
And it's profitable enough to do that. So you're absorbing indoor industrial space by the hundreds of thousands, millions of square feet across the country in markets that it's now legal to grow. So that's been a huge driver.
Yeah, and I think it's legal in almost half the states, if not more now. So that's a lot of square footage. And like you said, that was probably older, cheaper square footage anyway that was just absorbed back into the market. So that was great. But back to what you said earlier on interest rates, with interest rates being this low, we've talked about a cap rate before, and we use cap rates to evaluate what a property could be worth based on the income it produces. So when the debt is cheaper, we're typically borrowing, 75 to 85% of the cost of that deal from a lender. And if they're charging us 1 or 2% less on $5 or $6 million or $10 million or $100 million, you can see how that adds up really quick. And you can make a lot of deals work because it puts the cash in your pocket because the lender is charging less, right? Mm-hmm. So you can see how that adds up. Okay, I can afford to buy a nicer asset because the loan from the bank is so much cheaper.
Yep, positive leverage where you're borrowing, or you have an asset that produces 8% and you're going and borrowing the money to buy that at 4%.
So what's going to happen when the interest rates rise on that? Are there going to be less buyers because their return's not as good, or do cap rates rise or fall? I mean, you have any opinions on that as interest rates rise?
Yeah, I think cap rates have always kind of historically been tied to the availability and the cost of debt. In some respect, people have to take that into consideration. Most people aren't out here paying all cash for this. The debt's evaluated.
Yeah.
It typically puts pressure on the sales price. And in multifamily and industrial and some of these hotter asset classes that are so expensive, it's pushing cap rates down. So your cash yield each year is going down and down and down. But when you're trying to refinance that or get out of that in an interest rate market that is multiple points higher, it may not only not work, but it may not even be able to service the debt of the refi. Yeah. You may be selling for substantially less, right?
Yeah, so people are looking at evaluating multifamily deals, and today they say, well, I can get a debt at 2.75 or 3 on a multifamily deal.
Which is stupid cheap. I mean,
super cheap. Let's say years ago it was 5. Okay, so now I can get it at 2.5, 3, 3.25. So that allows me to bring that cap rate down, and I can buy at a 5 or a 5.5 cap. Somewhere you can go in lower, and I can still ink out some positive leverage.
Yeah.
Well, what the point you're making is, okay, if I get a floating rate, or if I get a 5-year fixed rate, or even a 10, what happens at the end of that?
Correct.
And so 10 years is a little bit better of a hedge, because at least you've paid down principal over 10 years.
Right.
But a lot of these are interest-only loans for 3-4 years, so you may not pay it down that much. And if the rate goes from 3 to 3.5, not a huge deal. But if it goes from 3 to 5, that could be a problem. Now, how they're going to underwrite around that is rent growth.
Sure.
And so it just becomes a little bit of a riskier game in a rising interest rate environment, because you really do need rent growth to cover you in the event of higher interest rates in the future. Where before, or the last, let's say 10 years or so, it's like 2007, since then, rates have been down. They immediately during the recession lowered them. They may have started to tick up, and then they brought them all the way back down. So you haven't had to worry about that, but I think it's time for people to start putting that into the equation.
Can you usually get an increase in rent when inflation is taking over like it is now? Can you kind of match that with increases in rent? I know a lot of times, of course, the leases aren't coming up for 2 or 3 years, so you don't know. But any leases that are coming up due right now, can you get an increase in rent and say, hey, inflation's taken over, so your rent's got to go up too?
Yeah, and I think you've seen that everywhere, from gasoline to milk at the grocery store, right? If you used a service 6 months ago and you're using it now, there's no question it's more expensive. So I think your tenants are going to be feeling that exact same thing. Man, they're
going to know it and sort of expect it probably.
Yeah, and
everything else is going up.
I've seen it built into a ton of leases. I mean, how many times have we seen commercial price index increases in a lease?
Yeah,
I mean, you're not seeing that as much. There's probably a lot of CPI index written leases this year, though. I can bet you that.
Oh yeah,
because inflation is 7, 8, 9%. What in 2021 or now? That's a ton.
Yeah, and multifamily is you're usually on a 1-year deal.
Yeah,
1 year
multifamily, right?
And so, as but you're always having them roll every month. You'll have a certain percentage,
right,
maybe 10%, 15% rolling, and so you get a chance to adjust it. But it's not an arbitrary. Oh, as a landlord, CPI is high, so I'm going to raise the rent. Yeah. It's really market driven.
Yeah,
and there are analytics you can use, but it's really just in that area, a similar type apartment complex. What are they renting for in the market? But with inflation and with costs going up and with demand high, the rents will drive. They'll come up.
I think you're also seeing it in the new construction single family market as well. The demand for a brand new construction house is insanely high. It almost seems like they can't build enough houses. If you look at the houses built last year and even the previous 5 years, I mean, they're hundreds of thousands less than in 2007, 2006, before the big crash. I mean, there's no doubt there's a massive demand, and it's easy to get debt for a new house. I mean, it's still really easy. The debt is still super cheap. So I think there's a lot of people that are stuck in an apartment, so to speak, because there's not a house.
That's a good point. Let me think about that. So right now, you can watch the news, cost of construction, cost of materials.
Through the roof.
Through the roof.
Yeah.
Well, okay, so then new houses are more expensive to buy, and which makes it harder for apartments, people living in apartments, to go buy their first house.
Correct.
Yeah. Well, that's positive pressure pushing up apartment rents, because they can get away with charging more for the apartment, because they know, hey, your alternative is to go buy a house, and those are getting really expensive. So all these factors are pushing up prices.
Well, the other thing that pushes it up is that with rising interest rates and rising costs, people aren't going to want to build, companies aren't going to want to build new apartments probably right now, right? Because it's a little riskier. So that means
you'd have to be crazy to build new apartments right now.
You would, really crazy.
So Joel's in the middle of a ton of brand new Class A apartment development that I'm sure will go great, but that was really funny.
I'm not sure they're going to go great. I'm not arrogant. These are my first developments, but we're trying to do it the right way. And I'm counting on rent growth, right? I'm counting on not only rent growth, but also demand, because like you say, a lot of people may not be starting new developments,
right.
And we are already in the middle of ours. So hopefully when I deliver it, there'll be a high demand and we can get the rents that we need to cover our costs.
Yeah, and just something like that. I mean, I remember kind of looking at the model when we first started it, and the rent growth you've seen just in modeling since the first time you put a model together on, hey, this is where we're going to start. This is the rent we need. Maybe that's $1.35, $1.40, $1.50 a foot. Maybe that's $1.65 now. The rent growth you've already perceived in just planning the apartment complex that you didn't realize, obviously, because it's not there. But that helps bring some confidence, knowing it's going in the right direction at least.
So then what are people to do that are looking at getting into commercial real estate? For me, what I would say is now's a good time to sell. If you own assets that you have maximized value over the last 10 years, now's a great time to try to exit that. But
why is that? Why do you want to exit now?
Well, because I think right now we're seeing prices in a frenzy that are high. The demand, I haven't seen the demand higher. Now, it doesn't mean prices aren't going to go up, continue to go up. They probably will. But at some point, you have to say this is a good time to sell. Could 6 months from now be a good time? Sure.
But now is.
But now is a good time if you have been holding the last 10 years. But you have to think about what you're going to do with the money. Do you want to pay your taxes? Do you want to pay a big tax bill and just put the money in the bank and wait for an opportunity? Do you want to try to 1031 exchange that? Well, if you're going to 1031 exchange it, now you're going to have to go buy a property at the top of the market. So that's tough. So there isn't a great answer for everybody. We're going to look to sell strategic assets, but most of our assets we're going to hold through. We're going to continue to try to maximize value by increasing rents, and we're going to take that cash flow and we're going to just pay out to our investors like we said we would. Now, go ahead.
It's also a great time to buy in that same respect. Interest rates are still really cheap. You can find some great yield out there in retail, and people are still buying multifamily. They're obviously thinking they can make money. So, there's activity on both ends. Obviously, we're still buying. We're out in the marketplace finding good deals.
I'm still a buyer. Net, I'm a buyer. But you just have to. There are some risks associated with the stage of the market that we're in that you just have to be thinking of. But good deals are always going to be out there. Someone's always going to need to sell for whatever reason. Yeah. There's always going to be something that an owner doesn't see with how to maximize his property that you could see. So I think there's always opportunities to buy even through the cycle.
Yeah, and I think over the past year or two, we've seen so much cap rate compression, so many values just go through the roof on our developments, on Kitty Academies. We're underwriting a cap rate. We hit 50 basis points lower on a single tenant restaurant deal we did. We're underwriting a cap rate. We got almost 200 basis points lower. So, when we're looking at these deals, you have to take that into account. Hey, you may be building something today, you may be buying something today, but 5, 7, 10 years, you need to be able to look in there and forecast and reasonably say, hey, here's what I think I would do in that situation. If interest rates are this, we can sell and it will still be okay. If interest rates are that, we can refinance and keep the asset. You need to be looking forward and paying attention to these things.
Yeah, and I think now's a great time to be really, really thorough with your underwriting and really position yourself. If I have to hold this asset, can I do it? If the market turns on me, am I going to be okay to hold this asset through the market cycle correction? Mm-hmm. Yeah. And that's important because there are people that they just got into multifamily, let's say 4 years ago. It's done nothing but skyrocket to the moon. And they think that they're the best investor ever.
Yeah.
Every deal they've done is it just exceeds what I projected. I am so good at this. Yeah. Well, maybe you're really good at it, but maybe you just happen to be in a window of several years where nobody lost money in multifamily. Yeah. Yeah. And that breeds a little bit of carelessness. Because they're not gonna be as stringent in their model. They're not gonna be appropriating the right risks, and some people are gonna get burned because of that situation.
Yeah, there's the saying, I'd rather be lucky than good, but in real estate, I'd rather be good than lucky, because you may hit a lucky deal, but if you have really shitty underwriting practices, it's going to burn you. And like you said, now's the time to be cautious and be thorough.
So in underwriting right now, you'd recommend being a little more conservative. Maybe you put a little bit more CapEx because you think that the costs are going to go up.
All I'm saying is
you
can't keep underwriting cap rate compression. For a lot of the time you could, hey, this is going to be nicer. Hey, we may not increase the rent much, but the rent we have is going to be worth more. Or, the guys who bought an apartment building for $50,000 a door on a 6 cap, that was stupid when they bought it, and they sold it on a 5 cap and did nothing to it. Back in the day, you used to have to work really hard for rent growth in multifamily, and it costs you a ton of money. It costs you refrigerators, remodels, new cabinets, painting. It costs you so much to be able to say, hey, I am a good owner. I'm increasing where you live, and I need $20 more a month because that's where I'm going to make my money. And you would go in with this plan, this rehab. And now you see people like Joel, they're just going into markets with insane rent growth, buying it, power washing it, and putting it on the market a year later and making millions of dollars.
Yeah, and I've been too conservative over the last few years, because I really cut my teeth through the recession. So I knew how bad it could get. And so I've missed out on a lot of deals where new guys have come in and just been buying up everything, not really worrying about the risks. And they're making a ton of money, and I give them credit. So you can win at real estate a bunch of different ways. But yeah, we're being a little more careful. I think to wrap up and looking at how do they go about approaching deals is you need to underwrite increase in interest rates when you refi. Before maybe you didn't have to do that, but I gotta believe the Feds. We already know they're going to hike in March.
They've already said
they're probably going to hike 2 or 3 times this year
or more.
So if you're getting a 10-year fixed deal, okay, maybe that's a guessing game in year 11 what happens. But if you're at if you're getting a 5-year fixed, a 3-year fixed, or a floating rate, it's going up. So that's number one is make sure you're accounting for that.
And you have to account for it multiple ways, right? Because you don't have to just assume the interest rate's going up if you were to refinance it and keep the asset. But if the interest rate went up and you wanted to sell the asset, somebody would pay less for the asset because the debt they're getting was costing them more. You understand what I'm saying?
It's a double hit,
right?
You're going to be out of options if the interest rate rises too much.
Yeah, either way, sell or hold, it's affecting you.
Yeah. And that's why I want to be able to hold assets through whatever market correction there is, rising interest rate, because eventually the market will heat up again.
Yeah.
So as long as you're playing the game for the long run, you're going to be fine through some of these market changes.
Yeah.
Well, thanks for tuning in to How to Invest in Commercial Real Estate. If you've got an idea for our next episode, be sure to leave it down in the comment section below. And we'll see you next week with another episode.
All right. Thanks, guys.